Ever ignored an email and then 2 months later you're in a full-blown panic because, oops, it was important? Well, imagine that email is from the IRS, and instead of a polite reminder, it's a whopping 50% penalty on your retirement savings. Yeah, that's the nightmare scenario when you ignore required minimum distributions, RMDs. Welcome back to the channel. Today, we're talking about a sneaky but critical error that DIY retirement planners often make: ignoring required minimum distributions. Don't worry, we're breaking it all down with plenty of humor, actionable tips, and maybe a few wake-up calls. But first, hit that like button, subscribe to the channel, and share this video with anyone you know who's close to retirement. They might not say thanks now, but they will when they avoid a massive tax penalty. Alright, let's dive in. Let's start with the basics. What the heck are RMDs? RMDs, or required minimum distributions, are mandatory withdrawals from your tax-deferred retirement accounts like 401k, traditional IRAs, and certain other plans. You're required to start taking them at age 73, as of today's laws, or face a penalty. And by penalty, I mean the IRS swoops in and takes 50% of the amount you didn't withdraw. Why does this exist? Uncle Sam was nice enough to let you defer taxes while you were saving, but now it's payday for him. Think of it like the IRS saying, "You've been holding on to my money long enough, time to share." And if you ignore them, oh, they'll make you pay, literally. Now let's talk about where DIY planners often go wrong. Forgetting RMDs exist. Maybe you're focused on maximizing your Roth conversions or managing other investments, and RMDs just fall off your radar. Miscalculating the amount? The IRS uses a formula based on your age and account balance. Miss the math, and you could withdraw too little or too much, which triggers other problems. Not understanding tax implications. Every dollar you withdraw is taxable income. Pulling too much can push you into a higher tax bracket or mess up your Medicare premiums. Delaying until it's too late. Procrastination is fun until December 31st rolls around and you realize, oh no, I didn't take my RMD. Bottom line, ignoring RMDs isn't just a little oops, it's a big, costly mistake. Let's talk about this 50% penalty, shall we? Imagine you were supposed to take out $10,000 for your RMD but didn't. The IRS slaps you with a $5,000 penalty. Add that to the taxes you'll still owe, and suddenly, your nest egg is feeling a lot lighter. Oh, and don't think the IRS will forget about your RMD. They're better at tracking your money than you are. So, moral of the story. Missing your RMD isn't just a slap on the wrist, it's a full-on body slam to your finances. Alright, let's get practical. Here's how you can avoid RMD mistakes. Set reminders. Use your calendar, an app, or even sticky notes on your fridge. Mark RMD deadlines like your life depends on it. Automate withdrawals. Many financial institutions offer automatic RMD withdrawals. Take advantage. Diversify with Roth accounts. Roth IRAs don't have RMDs during your lifetime. Converting some funds to a Roth can reduce your future RMDs. Withdraw strategically. Start taking distributions earlier if it helps smooth out your taxable income. Work with a pro. If you're managing multiple accounts, a financial advisor or CPA can help you navigate the rules. Following these steps won't just save you money, it'll save you headaches and maybe a few sleepless nights. RMDs aren't just about avoiding penalties, they're part of your broader retirement strategy. Think about how RMDs impact your tax brackets, Medicare premiums, and even your estate planning. Use RMDs wisely. Invest the money you withdraw if you don't need it right away. Or use it for fun stuff, like travel, hobbies, or spoiling your grandkids. You've earned it. Remember, RMDs don't have to feel like a burden. With the right strategy, they're just another piece of the retirement puzzle. Let me tell you about two retirees. Retiree #1, Forgetful Fred. Fred ignored his RMDs. He was hit with a 50% penalty, paid higher taxes, and spent months fixing the mess with his financial advisor. Retiree #2, Proactive Patty. Patty planned ahead. She automated her RMDs, converted some savings to a Roth IRA, and used her RMDs to fund vacations and gifts for her grandkids. Patty is living her best life. Be like Patty, not Fred. It's that simple. Here are some tools to keep your RMD game strong. IRS RMD Worksheet. Use this to calculate your RMD amount. Online calculators. Many financial websites offer easy RMD calculators. Professional advice. Seriously, a financial advisor is worth it if you're juggling multiple accounts. Don't wing this, folks, the stakes are too high. Alright, let's wrap this up. Ignoring RMDs isn't just a mistake. It's a financial disaster waiting to happen. The good news? With a little planning and some simple tools, you can stay ahead of the game and keep the IRS happy. If this video helped you understand the importance of RMDs, give it a thumbs up, smash that subscribe button, and share it with someone you know who's in or approaching retirement. Remember, the best retirement plan is one that doesn't just get you to retirement but carries you through it. Thanks for watching, and I'll see you next time with more tips to make your golden years truly golden.